Welcome back to the Deep Dive. Glad to have you with us again.
Great to be here.
Today we're diving headfirst into something that trips a lot of people up. Advanced commissions and other kinds of upfront earnings.
Yeah, it sounds simple, but the tax side can get surprisingly complex.
Exactly. So if you've ever been paid for work before you actually did it, or maybe even had to return some of that money later on, then this deep dive is definitely for you. We're going to untangle the tax rules for income you get before the services are done.
And crucially, what the deal is if those payments have to be repaid.
Think of it as, your guide through this often confusing part of finance.
Absolutely. Our mission today is really just to simplify this specific area of tax law. It affects so many people.
Right. Not just salespeople, I assume.
Oh, definitely not. Freelancers, consultants, real estate agents, anyone doing contract work, really. Even professionals getting retainers.
Okay.
Basically, if your income doesn't always line up neatly with when you finish the work, these rules matter a lot.
So the goal is clear guidance.
Clear guidance, yeah. What to do when you get paid in advance, and just as important, how to handle it if you have to pay it back.
To avoid those nasty surprises come tax time.
Exactly. It's about understanding it so you can manage things confidently without unexpected shocks.
Okay, let's unpack this then. Our sources start with the basics. Advanced commissions or other amounts. What exactly does that mean?
It's pretty straightforward, actually. It's money you receive for services you're going to perform in the future.
So cash now, work later.
Precisely. You get the payment up front, but the job itself might be weeks or even months away.
Sounds simple enough, but you mentioned a catch. Who does this core rule actually apply to? Is it everyone?
Good question. No, it's not universal. This rule specifically targets what the IRS calls cash method taxpayers.
And that's most individuals, right?
That's most individuals, yeah, and many small businesses, too. Basically, if you report income when you get it and deduct expenses when you pay them, you're likely on the cash method. And here's the kicker for cash method, folks, the part that often causes confusion. You must include these advance payments in your income.
Right.
In the year you receive them, full stop.
Wow. Okay.
Yeah, let me say that again because it feels, counterintuitive. The moment that money hits your account, it's considered taxable income for that year.
Regardless of when you actually do the work.
Doesn't matter. Doesn't matter if the project starts next year or if the client might cancel or anything like that. If you receive the funds, they count for that year's income.
Okay, wait. Let me just make sure I've got this crystal clear. Say I'm a freelance developer.
Okay.
A client pays me a $10,000 deposit in, say, December 2023. But the project doesn't actually kick off until February 2024.
Right.
My first thought might be, well, I haven't earned it yet, so it's 2024 income.
That's the common assumption, yeah.
But you're saying
Yeah.
that entire $10,000 has to go on my 2023 tax return.
Yeah.
Because I received it in December 2023.
Precisely. You've hit the nail on the head. For cash method taxpayers, your bank account is like the IRS's early warning system.
Huh. Okay.
That $10K in December 23 is 2023 income. Period.
And the logic behind that is?
The logic from the tax authority's view is dominion and control. Once you have control over the money, you can spend it, save it, whatever its income.
Even if you haven't technically earned it through service yet.
Exactly. It disconnects from work completion and ties directly to cash receipt. That's why, like you said, it catches people off guard.
So you can't just spend it all thinking you'll sort the tax out later.
You really shouldn't know because a chunk of that already has the taxman's name on it for the year you got it. It's vital for budgeting.
That is a huge aha moment, I bet. Really changes how you view upfront payments.
Definitely.
Okay, now, here's where it gets really interesting. Because life happens, right?
It certainly does.
Sometimes those deals fall through, clients cancel, agreements end, and you might have to give back that advance commission or payment.
Very common scenario.
It sounds like a potential nightmare if you don't know the rules.
Yeah.
So what happens then? How do you account for money that came in, got taxed maybe, and then had to go back out?
Right. And our sources are clear. There are two main ways this plays out. And the absolute key difference is when the repayment happens.
The timing. Okay.
The timing is everything. It determines the tax treatment completely. Let's start with the first path, the simpler one.
Please do.
Okay. The first scenario, the one you're kind of hoping for, frankly, is when you repay the unearned amount in the very same tax year you received it.
Okay. Within the same calendar year.
Exactly. So back to your developer example. You got $10K in December 2023.
Right. Included it in 2023 income.
But then maybe on December 28th, the client cancels. and you refund the full $10,000 before December 31st.
Okay.
Because both things, getting the money and repaying it, happened in 2023, the rule is straightforward. You simply reduce the amount you included in your 2023 income by that $10,000 repayment.
So effectively, it cancels itself out for tax purposes.
Yeah. Pretty much, yeah. Your net income from that specific transaction for 2023 becomes zero. It's like it never happened on your tax return for that year. Much cleaner.
That makes total sense. A nice clean wash within the same tax period.
Keeps things tidy.
I'm already thinking ahead. What if it doesn't happen in the same year?
Yes. The plot thickens.
You get the $10 K in December 2023, report it, maybe even pay some estimated tax on it. Then the client cancels in January 2024, and you send the refund then. Now we've crossed the year end.
Right.
Can you still just reduce your income? It feels like it should be more complicated now.
Yeah.
So what does this mean for someone repaying later?
You're right. It is more complicated. Once that repayment date slips into a later tax year, 2024 in your example, you can't just go back and reduce your 2023 income.
Okay, so what can you do? You've already reported it.
Correct. You reported it, possibly paid tax on it. So now the tax code gives you basically two different ways to get some relief in the year you make the repayment. So in 2024.
Two options. Okay, what's the first one?
The first option is you can take the repayment as an itemized deduction.
Itemized deduction, like medical expenses or state taxes.
Exactly like those. It goes on Schedule A of your Form 1040. The sources even point to the specific line, line 16, under other itemized deductions.
Schedule A, line 16. Got it. But that means...
It means you have to itemize your deductions for that year, 2024, instead of taking the standard deduction.
Ah, okay. So if your total itemized deductions, including this repayment, aren't more than the standard deduction amount,
then this deduction might not actually give you any tax benefit.
right. So the $10,000 repayment in 2024 could reduce your 2024 taxable income, but only if you're itemizing anyway. It's conditional.
Precisely. It's a potential benefit, but not guaranteed, depending on your overall deduction situation.
Okay, that's option one. What's the second path? You mentioned maybe taking a credit.
Yes, and this is where it can get potentially more beneficial for the taxpayer. A credit is generally better than a deduction, right?
Right. A deduction reduces your taxable income, but a credit reduces your actual tax bill, dollar for dollar.
Exactly. A $500 credit saves you $500 in tax. A $500 deduction saves you $500 times your tax rate, which is less.
Much more powerful.
Much more powerful. So the sources say you may also be able to take a credit for the repayment in that later year.
May be able to. So it's not automatic.
No, it's not automatic, and it's not for every situation. This credit option usually comes into play when the repayment amount is pretty significant.
Like how significant?
Typically, the threshold mentioned is over $3,000, and it's governed by some very specific rules the IRS has, which our guidance refers to under a section called Repayments, specifically mentioning Chapter 8.
Okay, so there are detailed rules.
Very detailed. Essentially, if the repayment amount is large enough, especially relative to the income you reported back in the original year, the law gives you this choice. Take the itemized deduction, or R, claim the special credit.
A choice. Interesting.
Okay. Yes, it's designed to provide fairer relief if you have to return a really substantial chunk of money that you already paid tax on. It prevents, an excessive tax burden from that timing difference.
So it's a strategic choice based on the numbers and the rules in that Chapter 8.
Absolutely. You'd calculate the benefit both ways, deduction versus credit, and choose the one that saves you more tax in the repayment year.
Wow, that's a fantastic distinction. It really shows it's not just about getting some relief, but getting the best relief possible under the rules.
Correct.
Okay, this is super practical stuff. But let's pull back a bit. Why should our listener, really care about these specific rules day to day, beyond just filing taxes correctly?
Oh, it goes way beyond just compliance.
How so? What are the real-world impacts on someone's finances, their planning, maybe even their contracts?
Well, think about it. Knowing that advance payment is taxable immediately when you get it, that fundamentally changes how you should budget.
Right. You can't treat it like free money.
Exactly. Take that $10,000 advance. You can't just go spend it all. You need to mentally, or better yet, physically set aside a portion for the taxes due for the year you received it.
Even if you haven't done the work yet.
Even then, ignoring that is how people get that horrible stomach-dropping surprise at tax time. What felt like a bonus suddenly becomes a liability.
A cash flow problem waiting to happen.
Definitely. And then knowing about the two repayment scenarios, same year versus later year, lets you plan proactively.
Wow.
Well, if you know a repayment might cross into the next tax year, you're now aware you might need to itemize or look into that special credit. This prompts you to keep really good records.
Documentation, date received, date repaid, amount.
Precisely. Having that ready makes tax time smoother. You can claim the right deduction or credit without scrambling. It avoids headaches, potential penalties.
And actually saves money by making sure you get the best tax treatment you're entitled to.
Absolutely. It shifts you from being reactive and maybe stressed to being proactive and strategic about your income and potential repayments. It's financial empowerment, really.
It's a much better position to be in. Okay, so let's quickly recap the core takeaways here.
Sounds good.
First, if you're a cash method taxpayer, advance payments for future services. They count as income in the year you get the money.
Non-negotiable. Year of receipt.
Second, if you have to repay that money, the timing is critical. Repay in the same year.
You just reduce the income you reported for that year. Simple adjustment.
Repay in a later year.
It gets more complex. You're looking at either an itemized deduction on Schedule A, line 16, or potentially, if the amount is significant and meets specific criteria outlined in Chapter 8, you might be able to claim a tax credit instead.
Which is often better.
Okay.
Got it.
Exactly. And just to leave you with a final thought to mull over.
Please.
Given these rules, especially the timing aspect, how might understanding this influence how you negotiate contracts or structure your own financial planning?
Interesting point.
Like, does it make you think differently about when you receive advance payments? Or maybe about adding clearer repayment terms in your agreements?
Yeah, knowing that a repayment on January 2nd versus December 30th has totally different tax consequences.
Yeah. How might that knowledge change your approach? It's definitely worth considering for your own situation, maybe even reviewing your current contracts or payment habits through this new tax lens.
Definitely food for thought. A great place to wrap up this deep dive.
Always good to talk through these details.